Tiffany, jump in here with your thoughts on the market reaction to what we saw today.
Yeah, well, I mean, clearly this was, I think this was a more dovish result than many had expected. I mean, I think only 2 dots were expected to come down and project actual rate cuts. But I think what we were expecting was to get this sort of tail risk guidance from the Federal Reserve, which we heard at the Monetary Policy Forum in Chicago a couple of weeks ago, which is to say that they emphasize, if the economic outlook darkens, we're here to do whatever it takes in the kind of Draghi language. They didn't say that, but we're here to do the right thing in order to stimulate the economy. I think this went one step further. They certainly opened the door, as others have suggested, to interest rate cuts on further trade escalation. But I do think that there is some fundamental weakness in the data that I would guess I would just emphasize. Our own forecast for the second half of the year is that growth is very likely to average about 1%. So it's going to be a pretty fragile time.
Wait, 1.0 or 1%? Who's counting?
1%. It's going to be a very fragile time in the economy. I think one of the reasons for this is that we've gotten a pretty decent amount of what we would call trade front-running behavior. So we saw the inventory buildup as well as some of the trade data. So that boosted growth in the first half of the year, and now it's going to subtract from growth in the second half of the year. So when you have these kind of heightened uncertainty, potential trade policy shocks at a time that the economy is already in a fragile state, I think it makes sense for the Federal Reserve from risk management perspective to really guide towards interest rate cuts if they're needed.
And I want to go to that idea of a fragile state of the economy because I kind of remain surprised by Powell's emphasis on the idea that sustaining the expansion is a priority for him. This is not exactly part of the dual mandate. And Ruchir Sharma of Morgan Stanley writes about how easy monetary and fiscal policy is strangling the global economy by keeping what he calls zombie companies alive. This is what he wrote. The problem is that government stimulus programs were conceived as a way to revive economies in recession, not to keep growth alive indefinitely. A world without recessions may sound like progress, but recessions can be like forest fires, purging the economy of dead brush so that new shoots can grow. Lately, the cycle of regeneration has been suspended as governments douse the first flicker of a coming recession with buckets of easy money and new spending. I'm not arguing for recession, but how do you drain some of the excesses across the economy if there isn't a period of slowdown or adjustment?
Well, I mean, I guess I'm not sure that, I think the one good thing about running the economy hot, which is what we were doing last year, and I think what the Federal Reserve is trying to do, is that you get some supply side improvement. So when you have recessions, you have people that leave the labor market because they become frustrated. You have other, investments that don't happen for productivity gains in the future. So you lose some capacity in the economy by going into recession. And I think that's what Federal Reserve officials, other than the zero lower bound issues, that's what Federal Reserve officials want to do without. So if you can run the economy hot, continue that sustained expansion, then maybe you can actually get more supply side growth for the future, more productivity enhancements for the future. So I think that's what they're trying to do.